So similar to the 1031 exchange is something we have as a Delaware Statutory Trust. It is a tool to defer the taxes, same like selling when you sell the real estate. So if you're not able to find any property, you can do with the Delaware Statutory Trust. And this is a trust created with a group of people like you, and they invest into something, another real estate property. It works in the same kind like 1031 exchange. You have to find the property. The property has to be purchased within 180 days. So it has all the same benefits. You will be receiving the passive income, but it comes from this Delaware Statutory Trust. The trust gives you the passive income. The only drawback I would say with the 1031 exchange and the Delaware Statutory Trust is in the 1031 exchange, you have control over the property. Here, it's a group of people go together to that state Delaware Statutory Trust and they purchase the property. So you're not sure about where the property is located or how the property is maintained. And the other drawback is the funds are tied up until the trust sells the property. You cannot sell the property.
So you're on the mercy of this trust. They have this management expenses. They have their salaries. We did not sell it. We don't have the right price. You are not the only investor. So DST is used only when you have no other option. You signed up for 1031 exchange and the last minute the deal fall apart. I can't pay the taxes. What do I do? So you just have to be careful with this DST idea. There are groups like oil and natural gas investment we were talking about, and you have a couple of other groups we'll talk about. There are groups who will have a lot of people like this who wanted to do 1031 exchange, couldn't find a property. Now they have identified property. They have this pool of fund, but then they have their load. The expense ratio is there. Just have to be really careful.
Coming to our next topic is monetized installment plan. So as we have discussed, many of you want to sell your business, have cash flow, but do not want to pay taxes. And this is where this comes into our hand. So the way it works is like if you sell your business and on an installment basis, so you're deferring taxes by not paying the taxes in this particular year because you get your income through an installment basis. But why did you sell your business? Either to reinvest or to purchase some other property or to have cash flow. Then what is the purpose? So the way this works is you can go to a commercial lender with your installment plan and take a loan against that. So in this way, you're deferring your taxes. You're not paying the taxes in a single go in this particular year, but you're spreading your taxes throughout the years. But at the same time, you're having enough cash flow for investment purposes, and also who do not want high net worth individuals who do not want to see a big tax spike can use this monetized installment plan.
So what happens, let's say if the gain is $1 million. Now suddenly you pay 20% tax if it's a capital gain, or if it's a short-term capital gain, you pay 37%. So you say, but you don't want to say, give me the money 10 years. This person may not give you the money. Mm-hmm. So you have an installment plan that you take to the bank to monetize it, to say, bank, I got 100,000. I have 9 installment of 100,000. How much money can I get today? And the bank is lending you the money. So you have the liquidity, you have the cash flow. For all practical purpose, you still have the installment plan where you pay tax on 100,000 every year for next 10 years. So lower income tax bracket, lesser tax, deferred tax for 10 years. So a lot of people use that.
You will be paying that interest rate.
They will be paying interest, and there will be tax benefit of paying interest. But then, end of the day, the idea is you will be making money by taking 7,000 as well. Or hopefully, you're making more money than the interest you're paying. With this theory, equity is more expensive than the debt, right? But the idea is, I want the cash now, and I don't want to pay the tax now. So you get the installment plan and monetize it.
It's simple as saying getting money now without paying taxes now. Yeah. So it's like the same thing. It's just with a small example. We sell a business for 3 million over 10-year installment plan. I get 300,000 upfront. If I would get the 3 million in the same year, I would be in a bigger, higher tax bracket. Instead, I would be sharing my, deferring my every year. But at the same time, I can take this as an installment plan to a commercial lender and can get some liquidity over it. So basing on that, this deferred sales trust is one which is formed by a group of attorneys, lawyers, and taxpayers. So if you want to defer your taxes when you sell your business, but you did not find a buyer who would pay you in installment basis. Instead, they want to pay you in a lump sum amount, but you do not want to take it. You do not want to increase your tax bracket. So this is the other option called as deferred sales trust. In this, a trust is created by a group of attorneys or taxpayers or accountants or some legal people. So how does it work is, I go to that trust and I say that I want to sell my asset, and I come into an agreement with them. The trust sells the property, sells the business in a lump sum, and they receive the lump sum amount. But they will be paying you on an installment basis or with additional interest. It depends on all the terms that you have with the trust that was created. So the first thing is, you're allowing continued growth. Even that investment, whatever, you can come to agreement like how that investment, that money, the lump sum money, can be invested into various things so that you can get proper returns on your investment too. So you sell your asset, you get it on an installment basis with the trust, so you're deferring your taxes.
So
And
in summary, what we are saying here, you have to say you want to sell the asset. You want an installment plan because you don't want to pay taxes. Nobody is there who wants to buy it on installment plan. What do? You sell this asset to your own trust. Then this trust is selling the asset to the individual. This trust got the whole money and this trust is paying you an installment. So you create a group of people coming together, creating the trust. But the idea is, I want to sell this building for $2 million and I want a 10 years installment plan. First, I want somebody who I can trust. You will give me money for 1 year and not give me the money. Second, I don't want to pay tax on $2 million. What do I do now? I create a DST. So I sell this asset to my own trust in theory. Then this trust is selling to the buyer. The 2 million comes to the trust. I decide how to invest and I keep taking 200,000 every. The money keeps growing in here. I keep taking 200,000, keep paying tax on 200,000 because I sold it to the trust on installment sale. The only thing is, the money is stuck in this trust with you.
Yeah, the main drawbacks comes here. It requires some complex legal and tax practices. Like the person who creates it has to have that knowledge of.
Right. A lot of these ideas, again, a lot of these ideas are slippery slope. Don't push it too far. Make sure you know what you're doing and follow the rules.